Imagine going out to your mailbox on a quiet afternoon, expecting nothing more than the usual stack of grocery ads, utility bills, a bank statement, maybe a card from a grandchild. You bring the pile inside, sit down at the kitchen table, and start sorting. Most of it looks routine, but then you see it, an official envelope with a return address that makes your heart tighten before you even open it. The Internal Revenue Service. At first, you tell yourself it's probably nothing serious, maybe a small correction, maybe a simple request for clarification, but as you unfold the letter and scan the words, your eyes freeze. According to the notice, you owe a penalty. Not a small one. $10,000. And the worst part? You have no idea what you did wrong. You didn't hide money overseas. You didn't run a side business under the table. You didn't try to cheat on your taxes. You simply put your own money into your own bank account. Maybe it was cash from selling that old pickup truck you no longer needed. Maybe it was money your daughter handed you to help pay for medical treatment. Maybe it was a stash of cash you'd been keeping at home for years and finally decided to deposit. All of it perfectly normal. The kind of everyday financial choices retirees make all the time. And still, somehow those normal actions resulted in a penalty that can start at $10,000. That kind of situation is becoming more common than many people realize. Because in most of these cases, the problem isn't illegal money. It isn't tax evasion. It isn't anything dramatic like the stories that make headlines. The real issue is something subtle and structural. It's a pattern, specifically a pattern of deposits or transactions that automated systems read in a very precise way. Systems that do not know your story, don't understand your good intentions, and don't see a lifetime of honest work. They see numbers, money in, money out, timings, amounts. When those numbers line up in a way the system is trained to question, quiet alarms can start going off deep in the background of the financial world. The results can be confusing letters, follow-up questions, or in worst-case scenarios, penalties that feel deeply unfair to the person on the receiving end. What makes this so unsettling is that the underlying rule behind it all is not new. It's not a 2026 invention. It's been on the books for decades. What's changed is not the existence of the rule, but how aggressively and efficiently it is being enforced using modern technology. Reports that once went into databases and sat unexamined, unless there was already a reason to look, are now being sifted through by automated tools that can cross-check financial data across institutions in seconds. In other words, the financial world has evolved into a highly digital, highly connected environment, and many retirees are still operating under beliefs that made sense 20 or 30 years ago, but can now quietly create real problems. That's why understanding the specific banking behavior is so important. Once you know what the system is designed to flag, avoiding trouble is much simpler than it looks. If you don't know how the rules work, though, a harmless trip to the bank can accidentally set off a chain of events that ends in that dreaded IRS envelope. Hi, I'm Timothy. I spend a lot of my time helping retirees protect the savings and financial security they spent decades building. Retirement should be the chapter of life where money feels stable and predictable, not a time when hidden financial rules suddenly jump out of nowhere. But in recent years, the way banks report certain activities and the way government systems analyze those reports has been shifting quietly. My purpose here isn't to scare you or make you afraid to use your own bank. Quite the opposite. My goal is clarity. Once you see exactly what causes problems, you'll realize that staying safe is mostly about awareness and adopting a few practical habits, not about fear or complicated strategies. In this conversation, we'll break down what kinds of everyday bank activity can draw serious attention from the IRS, why retirees are often the ones blindsided, and the single mistake that can turn a harmless deposit into something regulators classify very differently. We'll also talk about why enforcement in 2026 feels more intense, even though the core rule isn't new. Finally, and most importantly, I'll show you how to keep your banking habits simple and clear, so you never end up staring at a notice that looks like it came out of nowhere. Because once you understand how this system functions, one surprising thing becomes obvious. The move many people make to avoid attention from the government is often exactly the move that creates attention. Grasping why that happens is the key to protecting yourself going forward. Let's start with activities that, on the surface, look completely routine. Imagine a few scenarios that are very common in retirement. You sell your old truck for $15,000 in cash. The buyer comes over, counts out the bills at your kitchen table, and the next day you deposit the money. Or your son wires you $20,000 to help cover major medical bills. Maybe you've had emergency cash tucked away at home for years and finally feel safer putting it back into the bank. Some retirees receive a lump sum pension payout. Others sell a boat, an RV, or old equipment they no longer use. Sometimes you simply shuffle money between accounts to prepare for a big purchase or to help family. None of that is exotic. From your point of view, these decisions are common sense. It's your money. You earned it legally, saved it, or received it openly from family or legitimate sources. Putting it into your bank should be one of the most ordinary things you do. And most of the time, it still is. But there's a piece many retirees don't fully see. Banks today operate under a reporting framework that is stricter, faster, and more automated than the one you grew up with. They aren't just warehouses for deposits and withdrawals anymore. They're also legally required to report certain transactions that meet defined thresholds. This reporting process isn't meant to label customers as suspicious by default. It's about recording activity that crosses certain lines so regulators have visibility into large movements of cash. Every day, banks across the country quietly generate and send these reports through secure channels. You might never hear about it. You come in, deposit your money, receive your receipt, and go home. Somewhere in the background, the bank's system might have automatically filed a report. That report goes into a government database as one more data point in a very big picture. For many years, those reports often just sat there unless there was already an investigation for some other reason. Today's world is different. Now, those reports are fed directly into automated analytics that scan for unusual patterns almost in real time. The software compares reported cash activity against other financial data tied to your Social Security number or taxpayer ID. Things like prior tax returns, retirement distributions, Social Security income, and other bank reports. Those tools aren't judging your character. They aren't reading your mind. They're comparing patterns. Does this deposit match what we might expect from this person's overall financial profile? Is there tax reporting somewhere that explains this money? Do the numbers fit the story we already see in the system? This is where context, or the lack of it, matters. The system doesn't know you sold a boat last week. It doesn't know your daughter handed you cash to help pay for surgery. It doesn't know that you've been sitting on money at home for 10 years and just decided to bring it in. It only sees that a chunk of cash showed up in your account at a certain time. If that cash is large enough, and especially if it appears in a particular pattern, the system starts asking, where did this come from? And does anything else in the data explain it? To understand why those questions lead to penalties in some cases, we have to examine a rule you may have heard mentioned in passing. The Currency Transaction Report, or CTR. The name sounds technical, but the idea is straightforward. Under U.S. law, banks must file a CTR whenever a customer conducts a cash transaction above $10,000 in a single business day. It might be a deposit. It might be a withdrawal. It could be another type of cash movement. If you walk in with $12,000 in cash and put it into your account, the bank must report that transaction. Here's the part that often shocks people. A currency transaction report is not a fine. It's not a judgment. It's not the government saying you've done anything wrong. It is simply a record, a mechanism for financial transparency. Millions of these CTRs are filed every year. Restaurant owners deposit daily receipts. Individuals deposit money from selling cars or equipment. Families handle cash during big life events. The bank files the required CTR. The transaction is recorded. Then, in the vast majority of cases, that's the end of the story. For a long time, CTRs functioned mostly as quiet documentation. Unless other red flags were present, they barely attracted attention. They were there just in case an investigator needed to trace funds connected to an already suspicious situation. But in recent years, as monitoring has become more data-driven, CTRs are no longer just archived. They flow into systems that evaluate whether the deposit patterns look normal or crafted. That's still not the main problem for most retirees, though. The real trouble begins not with the deposit that triggered a CTR, but with the behavior people adopt to avoid triggering one. Because once you know that deposits over $10,000 get reported, it's very human to think, well, I'll just stay under that number. It feels like a clever way to stay off the radar. But in the world of banking rules, that instinct can be exactly what pushes you onto the radar. Picture this. You've got $12,000 in cash from selling an RV. You vaguely remember hearing that banks report anything above $10,000. So instead of depositing the full amount, you decide to put in $8,000 today and the remaining $4,000 a few days later. You feel like you're being careful. You haven't lied. You haven't hidden the money. You just spread things out a little. But on paper, in the system's eyes, that sequence can look like something very specific. Structuring. Structuring is the practice of intentionally breaking up a larger cash amount into smaller parts to keep each piece below the reporting threshold. Under federal law, structuring is not allowed, even if the money itself is 100% legal. This rule was created because years ago, criminal organizations used exactly this tactic to move large sums without triggering CTRs. The law doesn't just punish dirty money, it punishes certain patterns of moving money that are associated with hiding activity from regulators. Banks today have automated systems trained to spot structuring. They don't just glance at one deposit in isolation, they scan across days and weeks for clusters of cash deposits that together exceed $10,000 but are divided into amounts that look suspiciously designed to stay under that line. A string of $9,500 deposits, or $8,000 followed by $4,000 in close succession, can set off precisely those alerts. Once that pattern is detected, the bank may file additional reports beyond a CTR, reports that explicitly label the activity as suspicious. Those reports in turn can lead to more detailed review inside government systems. That's where serious penalties can appear, including fines starting around $10,000 in some cases. Even when every dollar is legitimate, having to prove that you did not intend to avoid reporting can become a drawn-out, stressful process. Here's the deep irony. A straightforward $12,000 cash deposit normally creates nothing more than a CTR that gets logged and forgotten. Splitting the same $12,000 into multiple smaller deposits explicitly to dodge that CTR can produce the exact pattern regulators are trained to scrutinize. The system doesn't know you were just trying to avoid extra paperwork. It recognizes the structure, not your story. That's why understanding this distinction is so crucial. A CTR is standard housekeeping. Structuring is an attempt, intentional or not, to sidestep that housekeeping. One is routine. The other is a regulatory issue. The simplest and safest strategy if you have more than $10,000 in legitimate cash is often just to deposit it in full and let the bank fulfill its legal requirement. This goes against the old mindset many retirees grew up with, where staying under the limit felt like the safer move. In a manual world, that might have been closer to true. But in today's automated environment, deliberately staying under the line is exactly what gets attention. One clear deposit aligns with how the system expects transactions to appear. Many small deposits arranged just under a trigger point send a different, more complicated signal. So how do you protect yourself going forward, especially in a world where systems, not individual people, are assessing your financial picture? The first pillar of protection is simple documentation. Anytime a significant amount of money enters your account, keep traceable proof of where it came from. If you sell a car, keep the bill of sale. If you sell a boat, keep the transfer paperwork. If a family member gives you money, a short written note stating the amount and that it's a gift, not a loan or payment, can be valuable. These documents create a narrative that backs up what your account shows. Many retirees are already organized in this way without realizing how powerful that habit is. They save receipts, write down important dates, keep copies of titles and major financial agreements. In today's digital age, you can scan these records and store them securely alongside your tax information. If anyone ever asks for an explanation of a deposit, you're not scrambling, you're simply pulling up a file. The second pillar is alignment between your banking activity and your tax reporting. When big financial events happen, selling property, receiving a pension lump sum, taking retirement distributions, they often appear or should appear somewhere on your tax return. When your bank history and your tax forms tell the same story, automated systems see consistency. Consistency is exactly what these systems are built to look for. Working with a qualified tax professional is a smart investment in this environment. A good advisor doesn't just fill out forms once a year, they help coordinate how your financial life is reflected in multiple records. If a large legitimate sale shows up as a deposit and is appropriately accounted for in your taxes when required, the dots connect cleanly. The third pillar is adopting transparency with your bank rather than trying to fly under the radar. If you have large legitimate cash to deposit, there's nothing to be gained by trying to disguise it as smaller bits. In fact, there's a lot to be lost. Let the bank process one clear transaction, file any needed CTRs, and you maintain a clean, simple financial history. When you combine documentation, consistent reporting, and direct banking behavior, you create a financial picture that's easy to understand from the outside. Automated systems see deposits, see supporting context, see tax filings that match, and move on. It's not your job to avoid every form or report. It's your job to keep your financial life coherent and well documented. It's also important to recognize that most retirees never face a problem in this area. Millions of people deposit money, move savings, and shift funds between accounts every day without issue. The ones who end up in uncomfortable situations are often those who, following outdated advice, try to be too clever about avoiding reporting. They don't know that the game has changed, that the safest path now is openness paired with organization, not stealth. The larger transformation happening in the financial system is this: everything talks to everything else. Bank records, tax returns, retirement account reports, Social Security income, brokerage statements, all of them form pieces of a puzzle that automated tools assemble. When your pieces fit, you appear as a stable, understandable profile in the data. When you introduce strange patterns like splitting deposits just below thresholds, that profile stands out. You don't need to become a financial expert to navigate this. You simply need a few core habits. Deposit large, legitimate cash amounts in one go without artificially breaking them up. Keep basic paperwork for major financial events. Ensure your tax filings reflect real financial activity. Periodically review your own bank history from an outsider's point of view. Would this make sense to someone looking only at numbers? Do those things and you put yourself in the strongest position available in today's digital environment. You're not trying to be invisible. You're content to be transparent because you know your records are in order and your actions are simple to explain if necessary. That is where real financial calm comes from. Not from trying to stay off every radar, but from knowing that if a system ever looks your way, what it will see is exactly what should be there.